Hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. It's a Wednesday morning, lots of cues to digest. The cues coming out of Wall Street are fairly subdued, but GIFT Nifty hinting at a start with a positive bias this morning. What will we be watching out for today? Broader markets, of course, given the fact that we saw a very steep sell-off come in yesterday. So that's something that we'll be keeping on our radar this morning. And of course, if you have any stock-related queries, send them in to us on our YouTube feed and we will have them addressed by your technical expert on the show. But before we go any further, let's take a look at the top headlines at this hour. Tech stocks erase Monday's gains, dragging Nasdaq lower ahead of the August inflation print. In fact, Apple slides after unveiling a new iPhone model, while Oracle sees its worst day since 2002 following disappointing guidance. Asian markets kickstart, the day on a positive note. Unemployment rate in South Korea falls to the lowest level since June 1999. In fact, the GIFT Nifty, as I mentioned, is suggesting a mildly positive start for the Indian market. Oil prices jump above 2%, in fact, to a near 10-month high on the back of OPEC's tighter oil supply outlook and strong demand forecast. Brent tops the $92 a barrel mark, and that is something that we'll be watching out for. It's actually on course to hit that $100 a barrel mark. And a fall in vegetable prices helps inflation ease to 6.8% in August, even as it cools from a 15-month high. Inflation remains above the RBI's tolerance band. Meanwhile, industrial output grows at 5.7%, slightly above expectations. That's at a 5-month high, if I'm not mistaken. Also on the show, we take stock of the mayhem we saw in the broader markets yesterday and put the spotlight on stocks like Infosys, IRCTC, Vakrangee and KEC International. And Apple announces 4 new models of iPhones, including the iPhone 15 Pro, while choosing not to hike gadget prices. Also unveils the brand new Apple Watch and updated AirPods with a USB-C charger. Well, as I was mentioning in the headlines, we had some positive macro data coming in last evening. We had inflation, coming in below that 7% mark, and of course, IIP data also above expectations. Let me bring on board, the executive editor of CNBC TV 18, Latha Venkatesh, to talk about, how inflation has come out, what is the trajectory going forward. Latha, and a cool off in vegetable prices, that's a much needed comfort, so to say, for Absolutely. RBI and and where the inflation is concerned.
It's a little more than that. Inflation coming in at 6.83. Our poll was at 7.08. Bloomberg consensus 7.1. So it's a good 27 basis points lower than what the market was expecting. And compared to the July inflation of 7.44, it is 60 basis points lower. So this is really a pleasant number. Pleasant in terms of expectations, pleasant in terms of the previous number, largely led by food. Food is, for the record, now in single digits, 9.94. Right. So much better than the 11.5% that it was rising in the month of July. Yes, as you said, largely led by vegetables. Vegetables are still up 26% year on year. But then in July, they were 37% up year on year. The fall month on month is largely contributed by not just tomatoes, but it has spread to other vegetables, though onions is still not as low as one would like it to be. Now, the unfortunate point in the food inflation number is cereals. Dals or pulses are up 13% year on year, and cereals, which have a big weight, are up about 12%, 11.85 to be precise. Not very good numbers. And unlike vegetables, which you can grow in 2-3 months, they're short duration crops. Cereals is the next kharif for many of them. For some of them, it is 2 crops, but it's going to be sticky. And then you speak of El Nino, lower reservoir levels. There is no guarantee that the cereal production in Rabi is going to be excellent or surplus. So there are worries. I mean, the Reserve Bank is not in a very comfortable spot. Only it is not in as bad a spot as it thought it was. Fuel inflation has come in well over 4%, about 4.6. But I think the impact of the LPG prices will show only in September because it came in end August. And core inflation is the positive. It's come in at 4.9 almost. The expectation was it would be 4.8 because July was 4.9 and the people were expecting it to fall. That it didn't fall can be a bit of a disappointment, but it's only a disappointment. It's not a big worry. All told, for a Reserve Bank which looks very closely at core inflation, this is a positive set, but I don't expect them to relax. There will be no let-up on the liquidity tightening which they have imposed, although the ICRR is getting phased out. They will do repo, the variable rate reverse repo to keep liquidity off. They don't want very easy lending. They are still worried about inflation. Well, but I think you should be happy about the IIP number.
Right, exactly. 5-month highs, if I'm not mistaken.
More than 5. I think it is about a 9-month high. The last that it was above 5.7. You could say 5-month high because 5 months ago it came to 5.6. But this is still 5.7.
Right.
So better than that was, I think, November. So that makes it, what, 8-month high.
Okay.
Good number, basically, better than expected. Our poll had thrown up 5.2. It's come at 5.7. Within that, some of the numbers like electricity is very heartening. 8% higher electricity output. And infrastructure is up about some 9% or thereabouts. Again, good going. It means that the states and the central governments are continuing to spend. The consumer non-durables, usually it represents what the informal sector and the rural, they are the big buyers. Non-durables are, soaps, hair oils, everything that perishes. So that it is done well at about 7.4 is good, but we shouldn't jump too much because last year's same time, that is the base effect is -2.
Okay.
So obviously, or -3. So obviously that looks good because of the base. Consumption would still be a spot of bother. But infra and electricity are making up for it. All told, when growth is higher than expected and inflation is lower than expected, we should be happy.
We should be happy. So you could say it's a double treat.
Yes,
for the economy.
you said it.
Thanks a lot, Latha ma'am, for taking out time and joining in and throwing a light on what the macro data has thrown up for us this time around. With that, let me also bring on board our technical expert for today, Hemen Kapadia of KRChoksey Securities, joining in this morning. Good morning, Hemen. Great to have you as always. Last time we spoke, we were way off that 20,000 mark, and now we have clocked that level decisively, even though there has been a lot of volatility after we reclaimed that level. But yesterday, the talking point, of course, was the broader end of the markets, given the fact that we saw the mid and small cap indices shed somewhere around 3 to 4%. So what should be the strategy, when it comes to the mid and small cap end of the market? Are we in the overbought zone there? And what are the levels now, the next level that you'll be watching out for on the index?
A very good morning to you, Nandita. Thank you for having me on the show. It's always a pleasure. Excuse me. See, frankly speaking, we were on a one-way trip as far as the mid-cap, small caps are concerned. Phenomenal move. Okay, the market liked the theme. Maybe it was playing catch-up. Maybe the valuations were cheap. But we actually went through the roof one way. I mean, see, the laws of gravity had to catch up sometime, frankly speaking, Nandita. And that's what is happening. So if you are in the mid-cap, small-cap space, I think technically we've seen a downward bar reversal coming in yesterday, which is a reversal sign, which is not exactly a good thing. But we need to see if there's follow-up action coming in today. But looking at the overbought situation and the way the reversal has come in yesterday, unless it is completely reversed, which looks unlikely, I think we might see a small period of consolidation. You can read it, you can term it as a correction, a retracement, or whatever. What I mean to say is a small period of cooling off as far as the mid-cap and small cap was necessary, which I believe seems to have come in. So I wouldn't be in a rush to buy mid-caps and small caps, but yes, in case the correction deepens, which is a possibility, not a very big deep correction, but I think quality stocks need a revisit, especially where could be panic selling for whatever reason. So for the time being, I think that's a strategy for mid-cap, small caps. As far as the market is concerned, Nandita, frankly speaking, the 20,000 went, is still there. In the sense that Nifty hasn't exactly gone down, obviously, like the mid-caps and small caps. I think Reliance is one stock which looks interesting. The IT pack looks good. Banks have held on. So, frankly speaking, I wouldn't say insulated, but the large caps and basically the Nifty seem to be better placed vis-a-vis the mid caps and small caps, at least for the time being. And 19,900, 19,800 to support levels as far as the Nifty is concerned. If we sustain above that, I think we could see a small period of consolidation, but I don't see a very deep correction coming in looking at the technical setup as far as the Nifty is concerned. Nandita.
All right, a deep correction is ruled out at the current juncture. But you mentioned the IT pack. I also want to get in your thoughts on Infosys. given the fact that, it's a stock of the day, according to me, given the fact that it has inked a multi-year deal with Europe's Stark Group, and it's for an undisclosed sum at the current juncture. We don't know the deal value as such, but it will be powering Stark Group's digital transformation journey. It will be providing AI-first services. But if you look at the IT pack, of course, it has held on, and ever since the disappointment with earnings, we've seen some of these stocks stage a very smart comeback. Look at Infosys. This stock is up over 8% in the last 1 month or thereabouts. How should one approach this now? Do you think it's the right time to buy into it, Hemen?
Yes, I think you hit the nail on the head, Nandita, absolutely. If I can just take 30 seconds of yours. If you look at the Nifty IT index, Nandita, we had seen a sell. I mean, some of the at the risk of sounding too technical, the MACD had given a sell somewhere in January of last year, Nandita. And now on the monthly chart, the Nifty IT index, the MACD is on the cusp of giving a buy. So frankly speaking, the entire pack, like you mentioned, has done well. In fact, some of the mid caps have gone through the roof. Coming back to Infosys, very valid point. Frankly speaking, Infosys was one of the weakest spots on the IT pack. TCS was the strongest, didn't go down much, buyback or whatever. But Infosys was one of the weakest, and now it's playing catch up. 1500 is crucial resistance. We are just at that point. But the setup, as far as Infosys is concerned, Nandita, I think it looks good. And if I can add, even Tech Mahindra, Wipro look good from a medium-term point of view. But yes, Infosys does look good. Most of the technical negatives have been washed away, and they slowly but steadily they've converted into technical positives, Nandita.
Right, that's the view on Infosys. Let's talk about the hot brokerage call that's come in this morning. Goldman Sachs, in fact, has come out with a report on Sapphire Foods. It has a target price of 1,800 rupees or thereabouts on the stock. It has a buy recommendation, and it expects a potential recovery for the company starting the third quarter. It believes that Q2 is a seasonally weak quarter for some of these QSR names. In fact, we have seen weakness play out in the likes of Jubilant Food as well, Hemen. But Cricket World Cup, that's, right from early October to mid-November, is something that is expected to, perhaps bring about a recovery for some of these QSR companies. Looking at the charts, how would you play some of these QSR names now? Would you say that, if there is some kind of dip, you should buy into it right now and perhaps wait for that recovery to come in the third quarter and then look at, taking some profits off the table?
Well, frankly speaking, Nandita, you answered your question yourself. You're absolutely right. I think one can buy now, sell it, and then, when the tip comes, one can look at it. I think that is a very apt summation of what you've done. That's the way it looks like. These are, like you said, some of these are niche companies, but yeah, they do make sense. So I would totally agree with you. Yes, but in this space, I just have one point to make. If there are some of mid caps and small caps, I would be slightly reticent in going the whole hog at one go. I think one needs to sort of, do an SIP sort of a thing where you like the company fundamentally. And looking at the current scenario, I would prefer some of the mainline stocks vis-a-vis a mid-cap or in the QSR space, Nandita.
Right, that's the view on the QSR space then. But let's talk about some of these railway stocks now, Hemen. They have been flying off the shelves, of course. We've seen a very, I don't know what to say, a stupendous rally coming in on some of these railway and shipbuilding stocks. Of course, yesterday they were under pressure. They came under profit booking. But would you say they are overbought and overheated on the charts, and perhaps now is not the time to jump into this sector?
Absolutely, Nandita. I completely agree with you. They are overheated and they are overbought. Frankly speaking, most of them didn't look like railway stocks. They looked like, rocket stocks joining Chandrayaan on the moon. But that was on a lighter note. You're absolutely right. They've had whether it's Matscout or Cochin or maybe the railway stocks, like you said, Nandita, you pointed out, very valid. They've absolutely gone berserk. So we need a dose of sanity. We need a cool off, which maybe has come in. I would say from a longer term point of view, things are hunky-dory. But in the current scheme of things, they've run up too fast, too quick. So a reality check is needed. And I think we are probably on the cusp, or we might probably be entering that.
All right, that's the view then on the railway stocks at the current juncture. But let's talk about, a stock like Heritage Foods. We have a query coming in from Prabhu on this stock, and he wants to know that, there has been a fair bit of weakness coming in on the stock. In the last 3 sessions, it has shaved off over 20% or thereabouts. If somebody is invested in this stock, would you say, perhaps book some losses, or, how should one approach it now?
If you have a near-term view, Nandita, I would go with what you say, book losses, because we walked into a corrective phase, and some of the weekly oscillators are showing weakness after 4-5 months. So, frankly speaking, I don't expect it to shrug this off and get up and start moving up again. It's going to take some time. And frankly speaking, the correction was for the asking, Nandita. The stock had made a high of 286 in October 21. We make a high of 287 in July 23, and it had moved up from 130. So the stock has doubled. You walk into a multi-year resistance. Frankly speaking, a correction was due, and it's coming. Okay, now because of the market, it has been exacerbated and it has gone sharper and deeper than one would expect. But coming back, succinctly put, if you're a short-term investor, you need to exit. If you're a long-term investor, it's fine, but this is going to take a few weeks to sort of unravel.
Right. Okay, that's the view. I hope that answers your query. But let's talk about a Vedanta now. Hemen, Raju Sabu wants to know your thoughts on this stock. It has been in a downtrend. Even though we saw good up move coming in the likes of Tata Steel, etc. over the last few sessions, I think Vedanta is one stock that hasn't really participated. In the last 5 sessions, it's down somewhere around 5% or thereabouts. And even on a monthly basis, we've seen negative returns on this stock. So from the metals basket, if somebody has a Vedanta now, should they hold on and wait for a rebound to come in?
Well, not exactly. I would say hold on to some position, but like you pointed out, Nandita, it's apparently very weak. You can see NMDC, you can see Nalco, you can see Hindalco, like you pointed out, you can see Tata Steel, you can see SAIL, Hindustan Copper. I think most of the metal stocks have done well, and Vedanta has gone the other way and still doesn't seem to be in a mood to rectify that, Nandita. Currently, there's a 4-week sideways movement. There's a 5th week now, and this range is roughly between 232 on the downside and 246 on the upside. Now we're just about breaking that range. Now, if there is a decisive breach, 2 things will happen. It will continue the lower top, lower bottom scenario, and a 4-week sideways movement, which might have been a reversal, will then turn into a distribution and a continuation pattern on the downside, which might take it down to 220 or below. So, frankly speaking, things are not looking exactly very conducive. And despite a little bit of a flicker of hope, if we close below 230, I think one would sort of exit and stay away, because then a further downside cannot be.
All right, that's the view on Vedanta. Signs not very encouraging on the charts at the current juncture. But let's talk about a Trident. Hemen, we have a query coming in from Rakesh, wants to know what to do with this stock. The stock has come under a lot of pressure of late. Over the last 1 month, it has done fairly well, but I think last 5-6 sessions, it has shaved off somewhere around a good 10% or thereabouts. On the charts, do you see further downside going forward?
Extreme near term, I believe so, Nandita, because this mid-cap, small-cap weakness isn't expected to go away in a hurry. And I don't think Trident will remain unaffected completely. No. It has had a brilliant move from 3 rupees to 70, 70 to 25, 25 to 43, 75, and now we've walked in a correction. So frankly speaking, near term, yes, pressure can be expected, but the setup is not something which is very worrisome. There is support coming in at 36.50 and 32. So I would say if you have a slightly medium term view, you can afford to hold on. Once again, a shorter term view, I think exit would be the best option, because the stock was just getting out of a correction, and now we could be slipping back into it. Why? Because there was a swing high of 43.75 in July 22, and last week's high was 43.75 exactly in September. So we've come off from the swing high, which doesn't augur too well, at least in the near term.
All right, that's the view on Trident then. But what about the chemical stocks now, Hemen? We have a query coming in from Maheshwar Bhanu, wants to know your thoughts on chemical stocks, particularly alkyl amines and Balaji amines, but he wants your view with a medium to long-term perspective. Chemical stocks haven't really, been able to stage a very decisive comeback yet. But do you foresee that happening in the next couple of, say, months or perhaps the next year or so?
Well, Nandita, there were some technical green shoots. If you can look at the charts of, GNFC or maybe a Deepak Nitrite or many of these stocks where, like you mentioned, there has been underperformance or the stocks haven't done at all well. But they were just beginning to sort of, look good. You have LX, Lakshmi Organic, the code is LX Chemicals, Thirumalai Chemicals. So many of these stocks were showing a promise, and that's just sort of been, punctured a bit. Coming back to alkyl amines, we've been corrective for what, 2.5 years, Nandita, frankly speaking, and well, we still remain corrective. Having said that, we've seen a deep time as well as price retracement. So one standalone, I would not be too worried. Okay, there isn't any compelling reason to buy. But if I look at many of the mid-cap, small-cap stocks, they were sitting on top of Mount Everest. This stock is already come off it a long time back. So what I mean to say is, in the recent this humongous move, it's not participated. So that reduces the chances of it going down significantly. Coming to Balaji Amines, obviously the pattern is almost similar to alkyl amines. We come up from 5,200 to 1,932, and now we are at 2,219. So these stocks have corrected significantly time as well as price. So I would say over a period of time, they would consolidate. Coming back to your main question, 1 year, I believe we should see redemption earlier than 1 year. So there is some promise. Maybe the next quarter numbers would lead to a more clear move, but I wouldn't be too bearish at this point in time.
All right, not too bearish on the chemical space at this juncture. But Hemen, last query coming in on a CDSL. Stock has been on a tear, but yesterday we saw some bit of profit booking at down 4% or thereabouts. We've seen new demat accounts, of course, at a 19-month high. That's, of course, triggered the kind of rally that we saw on CDSL. But going forward, what's the strategy here?
Once again, if you're a longer term investor, the stock is going to 1,500, 1,800, and 2,000 over the next couple of years. In the near term, yes, if the stock moves from 900 to 1,430, we could be seeing some time as well as price correction. So I'd say near term, there could be a bout of volatility until we don't give a weekly close above 1,450. Stock could remain a bit iffy and flow with the mid-cap, small-cap sentiment. Longer term, I think it's a buy on declines, no doubt, Nandita.
All right, a buy on decline strategy on CDSL. That's the view. Then I hope that answers your query. But with that, we are timed out and we are done with the query segment for today. If we couldn't take it up today, don't worry, we'll try and take it up tomorrow. So there's always hope. But, before I let you go, Hemen, any stock recommendations for viewers this morning?
Yeah, I have a couple of stock recommendations, but they're more from a slightly trading point of view, keeping the market sentiment, which is still on boil, so to speak. Firstly, but they're conditional. Firstly, a sell call on BEL at 139, stop loss 145, target 127. There has been a reversal, high volume come off. Mechanical indicators have given a crossover sell. So I would be slightly negative, but this is probably a 10, 12 day sort of a call, not a very long-term call. Britannia is a buy, oversold, downside limited. Mechanical indicators have given a crossover buy. There is a hint of positive divergence also. So a buy on Britannia at around 4560, stop loss 4510, target 4660, trading buys and trading sells, none.
All right, those are the stock recommendations coming in from Hemen this morning. With that, Hemen, thanks a lot as usual for taking out time and joining in and addressing all of your queries as well. Well, with that, we've come to the end of this edition of Morning Trade. From me and the entire team, thanks a lot for watching. But of course, don't go anywhere because coming up next is Opening Bell.